This question tests knowledge of the advantages and disadvantages of issuing preferred stock as a source of corporate financing. Preferred stock is a hybrid security that has characteristics of both equity and debt. It generally pays a fixed dividend, has priority over common stock in dividend payments and liquidation, but usually does not provide voting rights. The question asks for a disadvantage to the issuing company. A major drawback of preferred stock is that investors typically require a higher rate of return than bondholders because preferred dividends are not legally guaranteed, are not tax deductible, and preferred shareholders rank below creditors in liquidation. Consequently, issuing preferred stock is often more expensive than issuing debt. Students should distinguish between legal obligations and economic obligations. Although preferred dividends may be omitted without causing bankruptcy, unless special provisions apply, companies generally try to maintain dividend payments to preserve their reputation and access to capital markets. Choice analysis. A. Preferred stock dividends are legal obligations of the corporation. Incorrect. Unlike bond interest, preferred dividends are generally not legal obligations. Failure to pay dividends does not usually force the company into default or bankruptcy. B. Preferred stock typically has no maturity date. Incorrect. Most preferred stock is perpetual. While this can benefit the issuer by avoiding repayment of principal, it is generally considered an advantage rather than a disadvantage. C. Preferred stock is usually sold on a higher yield basis than bonds. Correct. Because preferred dividends are not tax deductible and preferred shareholders assume greater risk than bondholders, investors demand a higher yield, making preferred stock a relatively expensive financing source. D. Most preferred stock is owned by corporate investors. Incorrect. Many preferred shares are held by corporations because of favorable dividend tax treatment. But this ownership pattern is not a disadvantage to the issuing company. Correct answer. C. Preferred stock is usually sold on a higher yield basis than bonds. Exam tip. From the issuer's perspective, debt financing is often less expensive than preferred stock because interest is tax deductible. Preferred stock usually requires a higher return, increasing the company's cost of capital and making it a less attractive financing option than debt under many circumstances. This question tests understanding of bond pricing and interest rate risk, one of the most important topics in fixed income finance. Interest rate risk is the risk that a bond's market value will change because market interest rates fluctuate. In general, bond prices move inversely to interest rates. When interest rates rise, bond prices fall, and vice versa. A key determinant of interest rate risk is time to maturity or duration. Bonds with longer maturities have cash flows extending further into the future, making their present values more sensitive to changes in market interest rates. Therefore, long-term bonds experience larger price fluctuations than short-term bonds for the same change in interest rates. Students should also distinguish between a bond's coupon rate, which is fixed when the bond is issued, and its yield to maturity, YTM, which changes as the bond's market price changes. Choice analysis. A. The coupon rate and yield of an outstanding long-term bond will change over time as economic factors change. Incorrect. The coupon rate remains fixed throughout the bond's life. Only the bond's yield changes as market interest rates and bond prices fluctuate. B. A 25-year bond with a coupon rate of 9% and 1 year to maturity has more interest rate risk than a 10-year bond with a 9% coupon issued by the same company with 1 year to maturity. Incorrect. If both bonds have 1 year remaining until maturity, their original issuance dates are irrelevant, and their interest rate risk is similar. C. For long-term bonds, price sensitivity to a given change in interest rates is greater the longer the maturity of the bond. Correct. Longer maturities imply greater duration and greater price volatility when interest rates change. D. A bond with 1 year to maturity would have more interest rate risk than a bond with 15 years to maturity. Incorrect. The opposite is true. Short-term bonds have less interest rate risk than long-term bonds. Correct answer. C. For long-term bonds, price sensitivity to a given change in interest rates is greater the longer the maturity of the bond. Exam tip. Remember the fundamental rule. The longer the bond's maturity or duration, the greater its interest rate risk. Also, coupon rates are fixed, while market yields change continuously as interest rates and bond prices fluctuate. This question examines the factors that influence a company's cost of capital, which is the minimum return required by investors to provide financing. The cost of capital depends on the risk of the business, the firm's capital structure, market interest rates, and tax effects. Students should evaluate each statement individually, rather than considering them together. The key concepts are: operating leverage affects business risk. Lower operating leverage generally reduces risk and therefore lowers the cost of capital. Corporate taxes create an interest tax shield, making debt financing less expensive after tax. Debt financing is usually cheaper than equity because interest is tax deductible. Eliminating debt may increase the weighted average cost of capital WACC if inexpensive debt is replaced by more costly equity. Treasury bond yields serve as the risk-free rate used in models, such as the Capital Asset Pricing Model (CAPM). Higher Treasury yields increase the required return on investments and raise the cost of capital. The question asks, which events would increase the company's cost of capital? Choice analysis. I. The company reduces its operating leverage. Incorrect. Lower operating leverage reduces business risk and generally decreases, rather than increases, the cost of capital. 2. The corporate tax rate is increased. Incorrect. A higher tax rate increases the value of the interest tax shield, reducing the after-tax cost of debt and generally lowering WACC. 3. The company pays off its only outstanding debt. Correct. Removing debt eliminates the tax advantage of interest payments and increases reliance on equity financing, which is typically more expensive. 4. The Treasury bond yield increases. Correct. An increase in the risk-free rate raises investors' required returns, increasing both the cost of equity and the overall cost of capital. Therefore, the statements that increase the company's cost of capital are 3 and 4. Correct answer: C, 3 and 4. Exam tip: remember that higher risk-free rates increase the cost of equity, while debt financing provides a tax shield. Eliminating low-cost debt or losing its tax benefits generally increases a firm's weighted average cost of capital. This question tests understanding of the weighted average cost of capital WACC and the impact of replacing debt financing with preferred stock financing. WACC represents the average rate of return required by all providers of capital, weighted according to their proportion in the firm's capital structure. The critical concept is the tax treatment of financing costs. Interest payments on debt are tax deductible, creating an interest tax shield that reduces the firm's after-tax cost of debt. In contrast, preferred stock dividends are paid from after-tax earnings and are not tax deductible. Consequently, preferred stock is generally a more expensive source of financing than debt when both have the same stated rate. In this problem, Joint Products Incorporated replaces $1 million of 8% bonds with $1 million of 8% preferred stock. Although both securities carry an 8% stated rate, the after-tax cost of debt is lower because of the company's 40% marginal tax rate. After-tax cost of debt equals 8% times 1 to 0.40 equals 4.8%. Replacing debt costing 4.8% after tax with preferred stock costing 8% increases the company's overall WACC. Choice analysis. A. No change. Incorrect. Although the stated rates are equal, debt enjoys a tax advantage that preferred stock does not. B. A decrease, since a portion of the debt payments are tax deductible. Incorrect. Tax deductibility makes debt less costly, so replacing it with preferred stock would not decrease WACC. C. A decrease, since preferred stock payments do not need to be made each year. Incorrect. While preferred dividends may sometimes be deferred, the loss of the debt tax shield outweighs this feature. D. An increase, since a portion of the debt payments are tax deductible. Correct. Replacing tax-deductible debt with non-deductible preferred stock increases the firm's cost of capital. Correct answer: D. An increase, since a portion of the debt payments are tax-deductible. Exam tip: debt financing generally has the lowest after-tax cost because interest is tax-deductible. Replacing debt with preferred stock or common equity usually increases WACC unless other strategic considerations outweigh the lost tax shield.